Hello, everybody, and thanks for joining us. I'm going to wait a couple of minutes here to have everybody log on, but we'll get started shortly, a little bit after 11. All right, well, we'll go ahead and get started here so we can stay on time. Again, welcome everybody, and thank you for taking the time to join us today from wherever you may be tuning in. I'm Tyler Folsom, Vice President, Business Development. All right, as I'm sure many of us know, hurricane season officially kicks off June 1st for the Atlantic region. And the official forecast has been released with 13 named storms predicted. So in preparation for this time of year, we thought it best to discuss the following topics on our agenda today for addressing hurricane risk with parametric insurance. So we're going to start off with a team introduction first and foremost, an overview of parametric insurance, the climatology of hurricanes and the data collection behind it, the market gaps and limitations from a traditional insurance perspective, Descartes specific solutions to address those, parametric hurricane use cases, and then we'll wrap things up with a Q&A. So feel free to type in any questions you have along the way, and we'll do our best to answer them at the conclusion of our session. But first and foremost, I would like to introduce the folks on the call with me. I do have Conor Heffernan, one of our underwriting data scientists, and Jimmy Burnham, who is also Vice President in Business Development here. And you'll be hearing from both of them in just a short bit. But let's get started by introducing parametric insurance. So as I'm sure there are varying levels of understanding of this, we really just wanted to take a moment to just outline how it works and some advantages of this type of coverage. Simply put, a parameter just serves as an objective measure of how severe a natural disaster, weather event, or even a natural risk is. And this measure helps determine the exact coverage that clients receive. So when we're talking about objective measure, that could be anything from hurricane wind speed, the EF scale used for tornadoes, water height in the case of flood, or even inches of rainfall. So when a natural event does occur, this structure really does shine. And really the key advantages here to parametric are the transparency and preciseness. The triggers that are being used to determine coverage are incredibly clear. And all parties involved agree on these when setting up a policy. The policies themselves are customized to the client. So every coverage that we do is really catered specifically to an insured's needs. And the fact that we are using objective measures means we're very data driven. So any of the loss adjusting that is not done on the parametric front, it is not subjective. Again, everything is very straightforward and clear. And then, of course, most importantly, the swift payouts. This is where, again, Parametric really shines. And thanks to the continuous monitoring that we do, payouts are often made within days or weeks of an event, really providing that essential liquidity when insureds need it most. And with these payouts, the funds are highly flexible. So they're not earmarked for ways that they have to be used, but rather at the discretion of the insured to help fully recover from a catastrophic event. And even though parametric insurance is often referred to as alternative risk transfer, we really view it more as complementary. We're not pitting, traditional indemnity insurance and parametric against each other, but rather how they can coexist to create a really well-rounded risk management strategy. So with that, I am going to turn it over to Conor, where he will talk about the science of hurricanes and how the data from these events are collected and used. So go ahead, Conor.
Thank you, Tyler. So as Tyler said, my name is Conor, and I'm a tropical cyclone underwriting data scientist for Descartes based in London. And I'm just going to give you an overview on the climatology, the risk, and how the data is collected for hurricanes or tropical cyclone. Just a brief overview of tropical cyclone risk. They're among the most expensive NatCat events in the world. They are very large scale and cause very heavy wind. They can cause rainfall, storm surge, floods, and can even spawn tornadoes, as we've seen with Hurricane Milton in 2024 across Florida. And the risk is located mainly in the southeast coastal US, Mexico, large swaths of Asia, and also Australia. And the naming is slightly different depending on which part of the world you're in. They're usually called hurricanes in the North Atlantic, Mexico, US, typhoons in Asia, and typically elsewhere they're just referred to as cyclones. So due to the high concentration of assets in these cyclone-prone areas, the losses can be quite huge. And as you can see from this graphic here, the gap between economic and insured losses tends to be quite big and certainly must be addressed. So moving on to the next slide, just a little bit about the climatology and how they are measured. So tropical cyclones typically develop from a smaller tropical disturbance. These are then fueled by warm waters, which can gradually then develop it into a fully blown tropical cyclone. The intensity of these events is measured typically with a 1 minute max sustained wind speed, which is the typical measure or variations of this measure in different parts of the world. And it gives an estimate of the highest wind speed within the event at a certain time. This intensity can be best understood through what's known as the Saffir-Simpson scale, which has categories going from 1 to 5 based on this 1 minute sustained wind metric. So categories 1 to 2 are usually less severe and tend to cause minor damage. And then Cat 3 plus are classified as major hurricanes, in particular with landfalling Cat 5 hurricanes, causing catastrophic damage. The data is measured typically through satellites, wind measurements, and even planes where they fly them into the eye of the hurricane. And then this data is taken, collected, and then refined by experts at different agencies. And we get this data on our end from these different public agencies, depending on the region where the client is located. So within the North Atlantic, NOAA's National Hurricane Center is the main agency. And then you also have different agencies, for example, the Bureau of Meteorology in Australia, and you also have the JTWC and the JMA in the Pacific. We also rely on private data partnerships for wind field footprints. and these are used, we get these from our partners such as RMS and Risk, and these are used in certain types of deals, which my colleagues will speak to in just a little bit. With that, I'll give the word to Jimmy, and thank you very much for your attention.
Thanks, Connor. We're going to get into, as Tyler mentioned, where we can complement. I don't know if you guys see the next slide here. Let's pause on my end. Can you see it? Connor, can you see the next slide, or is it still?
Not on my side yet. I think there might be a slight lag.
Are we stuck here? Give us one moment here to get to the next slide.
Say it is showing on my end, so apologies.
Okay, I'll move forward. So as Tyler mentioned previously, as our policies, they basically complement the traditional market. So when we look at a traditional policy, we often do see a false sense of security. So first, we see these invisible gaps. So traditional business interruption is almost always tied to physical damage. So what happens if your building is fine, but the bridge leading to it is washed out? Or maybe the supply chain around your business is paralyzed. In the traditional market, if your roof didn't collapse, your insureds are likely on their own. We also, in the traditional market, see a sublimit squeeze. Although the market is softening, we still have yet to see terms and conditions soften along with rates. And so a lot of times we may have a $50 million limit on a policy, but if you look at the fine print, for name windstorm, that may be sublimited to $5 million, for example. So in that case, that would leave you 90% underinsured for the exact catastrophe that you're likely to face. And so you're basically just paying for coverage. You're basically not paying for the coverage you think you are. Instead, you're paying for that so-called gap. We also see the indemnity lag. So the second major shortcoming of a traditional policy is that claims are typically a marathon. They're not a sprint, so to speak. So we're talking anywhere from 6 to 18 to even 24 months of loss adjusters, audits, years of financial records. For many firms, this leads to death by cash flow. Your business might be viable on paper, but if you can't pay your contractors or make payroll next week while you're waiting for a check from the insurance company, the policy has failed its primary purpose. And so traditional insurance compensates you for the loss eventually, but it certainly doesn't protect your liquidity here and now. And finally, we've got, as I'm sure many on the call are well aware, strict carrier appetites. Even through a softening market, there's going to be automatic declination lists from the various markets. And so, they're basically walking away from some of the toughest risks. So we certainly see redlined areas, whether it's a zip code. Even if you do get a quote, there may be a 5% deductible or exclusionary language for assets like marinas or heavy industrial sites, which really makes the coverage feel more like a catastrophic last resort than a functional risk management tool. And so really the question here is, it's not whether you're covered, it's whether your coverage is actually designed to help your business survive a catastrophic event. And we'll get back to Tyler here to discuss some of our product solutions.
All right, thanks, Jimmy. We'll go ahead and jump right into the products and dive a little deeper to discuss our innovative insurance solutions. We've really designed these to address the shortfalls in traditional coverage, but first I'd like to introduce our Hurricane Cat in a Circle product. This is really an ideal solution to cover locations worldwide, whether it's in the Atlantic or other parts of the world that deal with cyclones or typhoons. And as you can see here, there is usually 1, 2, or even 3 circles centered around an insured's location. And if a hurricane enters one of them, the client is eligible for a payout based on the distance of the track and the maximum 1 minute sustained wind speed. So this example here uses the data reported directly from the National Hurricane Center, which is publicly available. So again, objectivity and transparency are really on display with Cat in a Circle. And of course, the data provider will certainly vary from region to region. And when it comes to customization, Descartes can truly cater the payout structure to fit an insured's needs. So if they were seeking coverage for a Category 1 storm, we could build around that. Or if maybe they were only concerned with the worst case scenario, Category 5, we could certainly build coverage around that. And we are able to deploy a very large amount of capacity with this product, up to 140 million. So we're really not shy when it comes to insuring risks prone to hurricanes. And this Cat in a Circle approach is really a great example of straightforward coverage. And then we also have another option to address hurricane risk, which is our wind at location. And similarly, it's an ideal way to cover, locations across the world. And for this product, the trigger is wind speed at the insured's location, irrespective of the hurricane track. So we're really removing the distance component here and focusing solely on the maximum 1 minute sustained wind speed based on the footprint of wind reported by data providers. And if we look at the payout structure for this one, it can get very granular based on the wind speed, but it also really proves that it's the strongest correlation to peak wind damage in a certain area. So in this example, we have the wind footprint showing a maximum sustained wind speed of 120 miles an hour. Again, not taking the hurricane track into account in terms of distance. And this one resulted in a 65% payout based on that wind speed of the limit purchased. So as you can see here, there are really two very viable hurricane solutions that can be customized to an insured's needs and are easily understandable. And what's important to note here as well is these hurricane products don't have a deductible. And they're truly first dollar and respond without any dollar threshold requiring to be met. So now obviously that begs the question, how does one actually apply these use of parametric products? And I'm going to turn it back over to Jimmy now, and he's going to talk about some real life examples and how these solutions can be used in conjunction with traditional insurance coverage.
So this next slide here is a story of a major global hotel chain with assets in Jamaica and their experience during Hurricane Melissa last fall, 2025. Devastating Category 5 event. In a traditional scenario, a storm of this magnitude leads to complete chaos. Local adjusters are overwhelmed, communication lines are down, and the hotel would be looking at months, if not a year or more, of uncertainty before seeing a single dollar from their insurance carrier. Because this insured carried a Descartes parametric policy, the process was entirely different. So let's talk about the trigger. So we didn't, as a company, we didn't wait to see photos of broken windows or damaged roof. The payout was tied purely to an objective index, and that index was a 1 minute sustained wind speed and the proximity of the eye of the storm to the asset. So before the storm even made landfall, the Descartes team was already in proactive communication with the client and the broker. 48 hours of the event, the final report was issued, the data was confirmed, and the trigger was met. And 22 days after the Cat 5 Hurricane Melissa made landfall in Jamaica, the client had a $5 million payout wired to their bank account. And so, our client was receiving those funds. A traditional claim would likely just be starting, waiting for an adjuster to even reach the island. And so, the impact here is we view this as a perfect combination of where parametric complements traditional. And so, what did that payout accomplish in those 22 days? it really bought them time. So it gave them immediate cash flow to start repairs, retain staff, allowed them to reopen their hotels in under just 2 months, when other competitor hotel chains were still scrambling in recovery mode. And as the risk manager for the chain noted in their testimonial, having Parametric alongside traditional insurance is the perfect combination. It's the liquidity that bridges the gap, ensuring that a natural disaster does not become a financial catastrophe. And Tyler, we'll go to the next slide here, and we can kind of just continue on with a few other industry use cases. As we kind of discussed, the insurance dance, so to speak, after a natural disaster, hoping that you get a check at the end. We wanted to show you sort of, the purpose today is to kind of show you all a different way to approach these risks. It's just not really about chasing damage. It's about triggering liquidity the moment disaster happens. And so here's 4 other sectors where we've been successful. Not limited to these industry verticals, but certainly just a few more examples to kind of get you all thinking. And so in the telecommunication space, for remote infrastructures like power lines, you can imagine site inspections are a nightmare. And so in this use case, we used a cat in a circle index to trigger immediate payments within days, enabling the insured to bypass inspections entirely. Construction is big for us as well. As the projects grow, they become more vulnerable. And so for this use case, we used a window location cover that scaled in value as the building continued to scale, protecting the project's financing against any sort of hurricane delays. Hospitality industry, huge sector for us. Many coastal hotels rely on NFIP along with hurricane cover, which leaves massive gaps in business interruption. As you all know, NFIP does not cover business interruption. And so we built in this case, a storm surge layer that provided instant liquidity the moment tourists stopped coming to their property. And then finally, condos, any sort of coastal condo is another huge sector for us. And this use case was large deductibles that they couldn't afford or wanted to hedge. And so we used a deductible buy down structure here that gave the residents instant cash for immediate repairs while their primary policy was still being processed. And so really, to kind of close here, whether it's a carve out for a specific project, a deductible buy down to protect your budget, all of these solutions that we're discussing today are really about one thing, and it's certainty. We move the conversation from sort of if the policy will pay to when the policy will pay. And so, in a world of, increasing climate volatility, as we've all seen, that speed in payout can really be the difference between a business that recovers and maybe one that folds altogether. And so at this point, we'd like to welcome, the opportunity to look at your specific exposures and see which of these structures fits your client's needs. And I believe we will move into a Q&A here. So don't be shy. I think we have a few frequently asked questions. And then if you guys want to drop any of those additional questions into the chat, we'd be happy to address them.
Thank you, Jimmy. As he mentioned, we're now going to move on to our Q&A session. So if you've not done so, please feel free to put your questions in for us. But in the meantime, we really wanted to address some frequently asked questions that we receive, and hopefully this touches on maybe some of the questions you guys are typing in right now. So number one, what are the shortfalls of standard wind coverage versus parametric? I really think that Jimmy covered this pretty well earlier, but to reiterate, traditional coverage doesn't often provide full capacity to named windstorm risks. Large deductibles are put in place. A lot of non-damage BI and contingent BI exposures are really left uninsured in the wake of these events. So, the risk appetite for hurricane exposed areas is limited. And even those that do right there may not want certain classes of business either. Whereas on the parametric side, there is no limitation of area that we're insuring, and there's no type of insured really that we won't cover. So those are good things to keep in mind when comparing the two. And number two, given the softening market, what are the advantages of purchasing parametric solutions? As previously mentioned, parametric solutions are transparent, and the payouts associated with them are incredibly fast. And when compared to, traditional loss adjustment process, and it's an extremely efficient use of insurance premiums. And with the decreasing rates in this soft market we're in, it really opens the door for insureds to reinvest those savings and start filling in some of those gaps and reducing the large retentions that they may still face. And then number three, what's your minimum premium? Well, that's an easy question. That's $25,000. So number four is, how do parametric solutions reduce basis risk? Jimmy, do you want to take that one?
Sure. Yeah, I think this is a big one that comes up often. And so, we sort of laid out some of the basis risk, so to speak, in the traditional market. There is a certain amount of basis risk around parametrics. But I do think that, one, we have a team here that has a lot of experience. And so that upfront structure building, I think, is really important. And so we've got, PhDs from all over the world. We've got, domestically here in the US, we've got a lot of experience within the insurance industry. And so as we are building the structures, we are really getting hyper local to make sure that, what has been that property asset's individual experience in a certain peril. And we can run back historical back test, 100 years to see, what events have happened in this at these coordinates, so that we can build a specific structure, solving solutions around your specific property. And so, we really, I think in the parametric space, the removal of basis risk occurs upfront during the underwriting and modeling portion, where we kind of take the guesswork out of it up front, where the traditional market, that guesswork and basis risk sort of lingers throughout the entirety of the policy period. And Conor or Tyler, if you want to add anything there, I know that's kind of a sort of a big discussion point.
I think that, Jimmy, you hit the nail right on the head there. But we'll jump to question number 5 now, as we've got a couple of questions coming in as well on the Q&A. Do you have an example of where parametric cover lowered the total cost of risk, Jimmy?
Yeah, I can jump in here too, Tyler. I think you look at price, like upfront price of policy versus policy, or deductible versus deductible. I think, any risk manager, worth their salt is looking at total risk cost over the course of a policy period. And so, as an example of our hotel chain in Jamaica, it's providing that immediate liquidity kept their doors open, kept their employees employed. What's the true total cost of a hurricane ripping through South Florida to your business? And if you're looking at maybe a 50-cent rate versus a 2 to 3% rate on line for a hurricane policy, I think that's the wrong approach to look at it from a price perspective. I think the experienced risk managers are looking at sort of the historical costs that they've experienced over time. And if you measure out sort of even just a 10-year period of specifically hurricane damage to a coastal business, I think our products, especially being first dollar payout, no deductible, I think our price is right in line with the market. But as far as like the total lowered cost of risk, I think it's gonna be case by case from loss experience to a loss experience. But I think overall we provide just a great value to a total risk program.
All right. Well, I know we touched on number 6 here as well in the presentation on how to integrate with the standard P&C placements. So I'm going to jump over to some of the questions now that we are getting in. There's definitely some good ones here. So I'm going to start with, in the event that a hurricane does not cause damage to the asset at the trigger point, but the forecasted revenue at that trigger point is affected, will the Descartes policy respond? So this is a perfect display of parametric insurance where the physical damage requirement is not there for parametric insurance. So if there is non-damage BI, where the asset itself is not physically affected by the storm, but it meets all of the other parameters that we've set, then the policy will trigger. So this is being afforded towards that economic loss that the insured is hoping to recover from, and Parametric will certainly respond in that case. And then another question here, any developments on different indexes that can expand Parametric solutions? Well, I think that's a great question. Conor, do you have any insights on maybe some different indexes that could be used other than the ones we've seen here?
Yep, happy to hop in on this one. So with hurricanes, another index that can also be used is the central pressure. The central pressure tends to correlate in the opposite direction with wind speed. So for example, a hurricane that is very high on the Saffir-Simpson scale and has high wind speeds tends to have very low central pressure, usually with the lowest point within the center of the eye of the storm. So we have certainly seen cases where we have done the index based on this. Something that can be a bit more common is what we would call a double trigger policy, where we can actually use both the wind speed and the central pressure as two indices, and then the payouts can then correspond to whichever of those indexes gave the higher payout for an event.
Awesome. Thank you. That double trigger question was also in here. So thanks for answering that too. All right. Who can buy parametric insurance? Individuals, insurance retail agencies, or only through MGAs? Jimmy, do you want to take a swing at that one?
Okay, so yeah, so Descartes operates as an MGA domestically here in the U.S. And throughout the globe. Who can buy parametric insurance? Individuals. So I think how we primarily distribute through dual channel distribution, retail, wholesale. We are more than happy to have conversations direct with insureds. We're very keenly aware that this is a new product, sort of new space that is obviously gaining a lot more traction throughout the market globally. And so I'm not sure if that answers your question.
All right. Well,
but that's sort of our distribution model. But happy to get on a call with individual insureds if there's ever a need.
Indeed. All right. So I know we discussed storm surge just a tiny bit, but what are the storm surge triggers and structure? I could speak to that one. Storm surge triggers are based on the water level height above the NAVD 88. So that's kind of a baseline sea level, depending on which location they are, and it's usually somewhere along the Gulf Coast of Florida. And the structure itself is based on that height above the NAVD 88. So you could start at 6 feet, 7 feet, 8 feet. And we put multiple of those types of policies together. So its storm surge is of specific focus. we can certainly create a policy around that as opposed to just the wind covers that we mentioned here today. And next question, do you use both REASC and RMS H-Wind for wind at location? Connor, can you confirm?
Indeed we do. Typically for the US we use RMS H-Wind, but we can certainly use REASC if the client has a preference for it in the US, and we use REASC typically outside the US, but yeah, certainly whichever one the client has a preference for, we've done deals for both. No problem.
All right, thank you. All right, we are getting a good flow of questions here. All right, is hail coverage an option? And if so, how is that triggered? Yes, we certainly offer a hail product, and that's based on the diameter of the hailstone size. And any product that we do provide on a parametric basis can be coupled with a hurricane policy. So it's not always just purchasing one peril. We've seen this, somebody adding on a tornado coverage to the hurricane or even a hail, depending on obviously their location and what perils certainly they're faced with. We can certainly add more than one to any policy. All right. What are the data sources you rely on to assess the wind speeds experienced in the location of interest? So depending on the product that's being used, the data sources for Cat in a Circle are going to be the publicly available ones, which for here, obviously in the US, is the National Hurricane Center, or NOAA. And then, of course, in the other parts of the country, it's going to be the typhoon or cyclone reporting agency, depending on their location. All right, let's see what other questions we've got here. What do you need for a submission? That's a great question. In fact, we have a slide here on how do you actually get a quote from us. So it's very simple compared to a traditional property submission that you're probably used to. We need location information. That can be as simple as the address or GPS coordinates, the peril to be insured, whatever limit you're looking for. And then if they do have loss information, that's really helpful. That can certainly help build a more accurate and responsive structure. And then any additional information, risk engineering reports that they might have, depending on, the location that they're in. So that's a really good way to get us a quote.
And Tyler, I'll jump in here. I think, the basis risk question, this is really where we work to remove as much basis risk as possible. For example, if you have engineering reports, we don't necessarily need those to return a quote. But if it's a fire resistant building that can withstand, up to a Cat 3, for example, and your loss history is maybe, the maximum sustained wind in that area maybe has only been a Cat 3, we can kind of base the structure based on that individual's specific needs. And so, we don't necessarily need all this information. It's just that the more information that we receive, the better that we can sort of remove as much basis risk as possible and sort of return the best solution possible for your insured.
All right, thanks, Jimmy. All right, it looks like they just want a little bit more clarification on how to place a parametric policy. Yes, PNC brokers are able to submit this to us. They work with the business development folks like Jimmy and I to submit this information, and then the proposals are sent to the broker and then obviously discussed with the insureds from there. So hopefully that clears that up. We're able to work with insureds directly, but that's not our main mode of distribution by any stretch. All right, a couple of these we've already answered. All right, can you explain how your sworn proof of loss works? using the example previously of no property damage and little VI losses, would Descartes be within their rights to claim losses back if the insured's losses don't meet the minimum payout? That is a great question. Well, the sworn proof of loss statement is obviously that there was some sort of financial loss to the company, whether that be, property damage or simply BI, extra expenses, things of that nature. But Descartes is not in the business of auditing any sort of after, claims are made. We're not asking for proof of this is how much the actual loss was incurred for. But that's not to say the reason why we spend a lot of time structuring the policies and having that conversation back and forth is to make sure we're not putting too much out there on the line that doesn't make sense. So that's why when there's previous loss information, it's a really good benchmark for us to structure a policy around to ensure that there's not an overabundance of funds being released to the insured, depending on the intensity versus, them just claiming the amount because they can. So, but that's to say, again, we're not auditing after the fact or anything, but, based on their proof of loss, that's what their sworn proof of loss statement, that's what we're going to go off of. And if the policy triggered as such, then the payout is afforded. All right. And okay, here's a fun question. Can you offer multi-peril coverage, frost, hail, and heat for the farming community? Jimmy, do you want to answer that one?
Let's see. Can you offer multi-peril cover, frost, hail, and heat for the farming community? Yes. If you can tie, if you can measure the weather, we can support. And so we look at frost heavily in the ag space, hail in the ag space, and heat. Yeah. So temperature. So temperature. Lack of heat or frost, hail, yeah, multi-peril covers for ag, 100%. We can support.
Perfect. All right, and following on from the hail question, how do you trigger that? And then, given the sparsity of hail size measurements, Connor, could you potentially speak to this hail?
I can certainly give a rough answer, but I'm certainly not a hail expert. But it's the data for the hail triggers is based on the diameter of the hailstones measured in inches. How this data is collected is after an event, NOAA has a sort of radar system which measures the reflectivity based that comes off of the hailstones, and then there's some algorithms which can then convert that sort of raw measurement into a pretty good estimation of what the diameter of the hailstone was as it hits the location that was affected. So from that, there's usually a kind of tracks footprint that are created afterwards, so you can see what sort of what size hailstones hit a certain area.
Awesome. Thanks, Connor. Is this a surplus lines product? Yes, simple answer. This is a surplus lines product. All right. One more question here. You're operating as an MGA in the United States. Do P&C brokers need an appointment, and what paper are you writing on? Yes, you do need an appointment with us, and we currently write on Generali paper. All right, and then
we're happy to quote terms. Happy to quote terms prior to any TOBA being signed. So don't if you don't currently have an appointment, don't be shy. We can certainly look at your risks prior to.
Absolutely. All right, I think we've got time for one more, and this should be pretty straightforward. given that this is based on, windstorm, but does Descartes offer parametric for other perils, earthquakes, and any other lines of business? So yes, that is any weather peril, anything naturally occurring you can think of, Descartes has likely insured it. So that could be earthquake, flood, hail, tornado, frost, lack of wind, any type of natural risk that can be measured and quantified would be something that we can certainly entertain. All right. I think that does it for the Q&A session here. So I think we're right on time. Thank you guys so much for joining us today. I know we had a little connectivity issues at the beginning, so thanks for sticking with us. But really appreciate you spending some time with us this morning, and feel free to reach out with any questions you guys might have. And thanks again.
Thank you.
Thank you all.